Welcome back to Market on Close. Just a few minutes left now in the trading day for this Wednesday, and it's time for the big picture. Let's welcome in the team from Charles Schwab, team of one, Kevin Gordon, Senior Investment Strategist at Charles Schwab. Thanks so much for joining us. What do you make of what we're seeing in the market today? I mean, Dan Deming just described it as impressive. We've seen the Dow staging a bit of a comeback. We've got some of the sort of value parts of the market continuing to do the heavy lifting here, consumer staples, financials, energy. I'm just wondering if that's how you would characterize it.
Yeah, I mean, I think it's really a continuation of what has started to take hold over the past week, where there's been, a lot more of this rotation and a little bit of an unwind of what's been doing well, not just since the April 8th lows, but also in particular what's become a more acute run for and a sharp run for the mega caps and anything tech and tech adjacent and AI related at the expense of the rest of the market. So a lot of it is a little bit of a reversal or an unwind in that momentum trade, where, as you mentioned, some of the sectors or the areas of the market that have actually been doing well have been those that have been left behind a little bit. So if you want to think about it in terms of whether the market's sending, a little bit of a scarier message, I don't think it's really that yet, because it's not just a pure classic defensive trade where only staples and healthcare are doing well. It has expanded out a little bit into, materials and real estate and industrials and financials to some extent. So I think it's a little bit more of a rotational message, not as much of a correctional message at this point.
Speaking of messaging, Kevin, the FOMC minutes are sort of coming out fresh just in recent hours. A divided committee, which is nothing new, risks to both sides of the dual mandate. The majority looking at upside risk to inflation. A couple saw downside risk to jobs. I'm just wondering, with all of that in mind, I mean, Jackson Hole was always going to be an interesting one, very critical for the markets, but I suppose this sets us up for an even more exciting one, I guess, given we're just going to be waiting to see, which side of that dual mandate Fed Chair Jay Powell really focuses on. What are you anticipating?
Yeah, I mean, I don't expect a whole lot from him in his speech in terms of where they're going to be moving, at the next meeting. We have to keep in mind that there's a whole other set of jobs data, another jobs report, but also, more inflation data that comes out. We'll get CPI and PPI before the next decision. So both of those reports have a pretty, significant, I would say, probability of changing the Fed's direction in either way. I mean, you could get another really cold jobs report with strong revisions to the downside that would probably solidify definitely a 25 basis point move. It would probably bring 50 basis points back onto the table, at least for discussion. But if you get, vice versa, a little bit of a reversal in the labor dynamic, and the labor market looks like it's holding up and it looks mostly like it's just a supply story, a lot of Fed officials and voting members, importantly, have pointed to that, where you can have a relatively low run rate for payrolls, meaning we can create fewer jobs each month, but not necessarily see the unemployment rate spike higher. That would shift a lot more focus, if not all of it, to the inflation side of their mandate, which, as you pointed out, in the minutes for this meeting, which I should emphasize, came, this happened before they got the jobs report for July. But even in that meeting, they were discussing being further away from their inflation target as opposed to their, labor target. So I think that's an important thing to keep in mind heading into this and then heading into Powell's speech, is that there's still enough people on the voting committee that have been pointing out the inflation risk. Those who have been pointing out more of the labor risk, that growing chorus of voices has been mostly, on the non-voting side. Not, of course, Waller and Bowman have been in that camp. But I think that's an important distinction to keep in mind, especially as we think about the setup for the vote heading into September.
Yeah, I mean, when we look at the setup, I mean, there are some who reckon we should just go 50, go big. And so it's not just become a question of, when, it's become a question of how much. I mean, is there a risk to the market given the pricing in for the probability of a September rate cut? I know that's come down, certainly in recent days. But, I mean, is there a risk to the market given what they're sort of baking in right now if Powell does not guide towards the potential for a September cut?
Yeah, I mean, there's a bit of a risk when you think about, if you get closer to, at or above 90% odds of the market pricing in, a cut in September, and the Fed doesn't follow with that. That is a pretty significant breakage with pricing. You probably get a little bit of a negative response to that. I do think, though, that if they're holding off because of relative resilience in labor and wanting to combat the inflation issue, I don't necessarily think that's a death knell for equities or the bull market. If the market's going to trade off of economic fundamentals fundamentals and the economy hanging in there, much like we learned last year when they started cutting, and then had to stop. It's not like the economy has materially worsened from that point. Yes, we've taken it down, we've downshifted and we've seen growth definitely slow, but not to recession territory. We haven't seen the economy implode. The labor market has broadly, held in there. So I think if they're slowing for the right reasons, or at least maybe entering a cutting cycle that's a little bit slower, that tends to be, more beneficial for the stock market in the medium to long term. That's not to say anything about what's going to happen in the short term if they do sort of disappoint against what the market's expecting. But I think that if they're holding off for the right reasons where labor is hanging in there, I would still think that's a better and stronger, more long-term fundamental story.
Okay, and then we've got the next big catalyst around the corner being NVIDIA as well. Kevin Gordon, it's been an absolute pleasure. Thank you so much.